Well, morning, everybody. Welcome to today's meeting of the Pension Fund Investment Subcommittee, held on the Thursday, the 26th of June, 2025. The County Council allows filming and photography at its public meetings, so feel free to take pictures and use social media during the meeting. Please, though, can everyone present turn their phones to silent or vibrate when the meeting is taking place? And I'm laughing because I haven't turned mine off, so I've got to do that. I'll do it in a minute. There is no fire alarm test scheduled for today. If the alarm sounds, I will adjourn the meeting and we'll leave the room by the side doors and use the external fire exit to the assembly point in the car park. A reminder that the public session of the meeting will be live streamed and a recording will be placed on the council's website. The meeting will be adjourned every 2 hours for a short comfort break. So item 1 on the agenda is the notification of the committee chair and the vice chair for 2025-26. The chair of the committee is myself, Councillor Geoffrey Seif, and the vice chair is Councillor Alison Whelan. I'm going to take this opportunity to just ask us to very quickly introduce ourselves around the table. It's not on the agenda, but I think it might be useful if we say exactly who we are. So if I turn to Councillor Whelan.
So I'm Councillor Alison Whelan, representing Ely North.
Chair, assuming we're doing officers as well, Michael Hudson, I'm the Executive Director of Finance and Resources.
Richenda Greenhill, Democratic Services Officer.
So Howard Nelson, Employer Representative.
Sam Gervais-Jones, Independent Investment Advisor.
Lee Gavin, I'm from the West Northants Council.
Hello, I'm Jonathan Crowther, and I'm the Investment Advisor from Mercer.
Ben Barlow, the Investments and Fund Accounting Manager.
Councillor Stefan Fisher, representing March North and Waldersea.
David Keane, I represent the Hemmingfords and Fen Stanton.
And Mark Whitby, the Head of Pensions.
Thank you for doing that. That's quite useful, as this is the first committee meeting of the subcommittee since the elections. Now, item 1 is apologies for absence and declarations of interest. The Democratic Services Officer will advise us whether there have been any apologies.
Thank you, Chair. Apologies from Liz Brennan and from Councillor Bowden.
Thank you. And does any member wish to declare any disclosable pecuniary interests or non-statutory disclosable interests? Take it that the answer to that is no. Item 3 is the public minutes of the subcommittee meeting held on the 27th of February 25, and we're being asked to approve these minutes as an accurate record. If any members have any objections, could you indicate them now? There were not that many members who were present on that time, but providing that nobody thinks they're inaccurate, we will take them as read and I will sign them in due course. Item 4 is the minutes action log. Are there any questions or comments on the action log? Although I think it does, yes.
Thank you, Chairman. Yeah, there's no ongoing items on there. So there was one item on there is now we've completed, and that was in relation to climate engagement and conflict zone investments, which is being brought into the stewardship report, which is later on the agenda.
Yep, thanks very much for that. That's indeed the case. And I'm going to take the action log as noted. We now turn to item 5, which is petitions and public questions. Now, we have one public question this morning from Avril Parkinson on behalf of the Cambridge Palestine Solidarity Campaign. Ms. Parkinson, you have up to 3 minutes to present your question. The traffic light will turn green when you start speaking and then turn to amber after 2.5 minutes, and you can conclude your marks when it turns red, because your time will be up at that point. I'm going to ask you, this is quite an emotive subject, so I'm going to ask you if you could show courtesy and respect to everyone present. I'm sure you will. And you must not use any inflammatory or discriminatory language. But beyond that, we welcome your question and we look forward to hearing from you.
Right. There's, I'll read out the question, but there's a very short preamble, which it is in my written part, which gives a little bit of history of our connections with the County Council on this matter. There has been correspondence since December, where the County Council said the ISC may consider at its next meeting whether it wishes to analyse further its exposures to certain business enterprises, etc. So that's what sort of encouraged the question. I'll read so it explains how the question's worded. So my question is, will the investment subcommittee choose to do this work and proactively engage also with pension holders and constituents, whereby the necessary up-to-date information can be shared with a view to finding a rapid pathway towards divesting from companies complicit in war crimes and genocide? We include constituents here as the County Council makes investments as a public body, which is accountable to its constituents and which has a responsibility not to be complicit in grave violations of international law. Within this frame, we refer particularly to violations developed now to such extremes by Israel that parties to the Genocide Convention, which the UK is, should be looking at their legal and other responsibilities. There's a bit more context of, I've given examples of public views, public actions, particularly in various ways. Particularly, you might be interested in very recently the motion that was passed by Peterborough City Council, which does have pensions within that motion, so that they will be interested. Also, hot off the press, as it were, Merseyside Pension Fund has now divested from Elbit and the world's largest arms firm, Lockheed Martin. So that would be worth looking into. They say that the choice of Elbit, it was to do with their score on the algorithms. So in summary, it's about divestment. It's about what divestment can achieve, both to send a signal and to actually have some effect. And in terms of public perceptions and what might work, disclose, divest.
Thank you very much. I'm going to ask members of the committee whether they have any questions for clarification on what has been presented, the question that has been presented to us. Now, these are for clarification only, not for debate. So can I ask committee members whether you want? Okay, well, I'm going to move to my response, which is, first of all, to thank you for your question. You will know from our documented investment strategy that we have an overriding duty to our members to meet our obligations in the long term. But within that policy, we have a robust policy of ensuring that, as far as practical, all classes of assets in which we invest operate to establish ESG, environmental, social, and governance standards, and demonstrate high ethical standards. As regards your specific concerns, you'll have seen from this published agenda that we have, in fact, examined whether the companies in which we do invest have direct investment in Israeli companies. And we have found that we have no direct investments, but we do invest in companies that deal and have links with Israel. And some of them, and most of the multinational companies, have a commercial presence there in one form or another. The estimated value of this fund's holdings is less than 4% of our total funds. And the extent of the interest of those companies, it varies. Some are almost minuscule. They trade, have some dealings, some have a little bit more. But when you take it in the round, the overall investment is very, very, very small. And that's a small proportion of their overall global assets. This committee will in due course be revisiting its investment strategy, and we will be taking advice from our officers, investment managers, and other professional advisors. And we will be looking at a range of ESG criteria, which will include your concerns. As a precursor to that, we will be consulting with representatives of employers and members of the fund, the pensioners. I'm going to pass over to Mark Whitby to just deal with the particular point that you made about constituents of Cambridge.
Thank you, Chair. Yes, so the fund has a legal responsibility to consult its investment strategy, and we have an RI policy within that with relevant stakeholders. The scheme advice, and we will do so at the once we've produced that. Prior to that, I think, as we previously said, we do intend to consult on the ESG views, the responsible investment views of the members of the scheme. You've mentioned constituents. The Scheme Advisory Board on the 17th of September 2024 did produce some guidance nationally around, and within that it included who you should consult with. And they said when acting within their fiduciary duty, the admin authority is legally obliged to limit itself to acting in the best interest of scheme members. And the views of local residents generally on ESG matters is not relevant. So we will be, the first consultation will be with scheme members. We will explain in the report the rationale for that decision. And as I say, later in the year, we will then consult on the full policies once they have been produced.
Thank you very much. Ms. Parkinson, I'm afraid you can't ask us a supplementary, but I hope we've satisfied you at least as to our process and going forward this morning. Thank you very much.
Okay, thank you. Nice to meet you.
Switched on, update on stewardship and engagement, and Ben Barlow, the funding manager, will introduce the report. Thank you, Ben.
Thank you, Chair. Yeah, it had become a familiar report that we were bringing quarterly. Really, it's just to show what's happened with voting and engagements with our current holdings. Those voting engagements at the moment are done by the fund managers that we employ in the fund. So I'll go through and pick out some of the main points, but it is quite an in-depth report. And what we always say about this report is there's a lot of information. So we're just trying to give a flavour of through examples of some of the votes that have taken place and some of the examples that have taken place. And it's a report that's sort of evolved over time, and it may well evolve into the future with new committee and new thoughts. So I'll start on the votes, which was in section 4. So there's been 118 votes. Now we classify these. So none of those were environmental issues. 18 were social issues and 100 were governance issues. Last month, or it might be the month before, we did actually look at how we were calculating those, because it does show a story where there's a lot of governance issues, but that is correct. That is a correct analysis of what we've got there. So of the 118 votes, managers abstained to vote 7 times. 75 times they were voting for manager proposals, and 36 times they voted against manager proposals. There were no instances where the fund manager has overridden the access voting policy. So they're doing what we've asked them to do in line with the policy on each of those vote opportunities. On engagements, which is section 5, there was 38 engagements, classifying them again. 13 were environmental, 11 social, and 14 governance. So a bit more of a spread here. The examples are in Appendix A, and obviously due to the confidential nature, that is a private appendix. I'll move on to section 7. So as we've just heard, there's much interest around climate engagement and our conflict zone investments. And following on from a question at the last ISC, we were asked to sort of bring through some details about where we are investing, and obviously that came at a good time in line with the question that we've had today. There's the information we've pulled out has been pulled out from the LGPS investment database. And as the chair has already stated, we've got around 4% there, so that amounts to 181.1 million in companies identified on this database. Again, as you pointed out, there's many multinationals within that, so there's sort of also almost a bit of a caveat that we need to identify those multinational companies that operate across the globe, such as McDonald's, Sony, companies such as that have a presence everywhere. And because of that, all funds across the LGPS will have holdings against this category of ownership. I appreciate that's probably the biggest topic that's in this paper. So officers are quite happy to take comments on that. So if the committee wanted more work or research in that area, we can do that. Obviously, you just need to approve any extra fees that might be on top for any work like that. But we're happy to go with the route of the committee on any extra work in that area, as Mark suggested in answer to the question. The only two other points that really are in the report to pick out, there's some details around engagements the team has done direct. So we speak to managers on a regular basis, and always, as well as pulling out the usual things you'd expect, like performance and fees, we do ask them questions on what engagements they've got ongoing and how they're voting, and make sure they're aware of the policies that we've got in place. And then there's also, towards the end of the report, there's the LAPF data. So LAPF is the Local Authority Pension Fund Forum. We love an acronym in pensions, as you know. They give you details of voting that's happened across LGPS, so not just a fund. So you'll see some of the big multinational companies in there that are being questioned on a number of topics. And again, that's something we bring through in the appendix. I wasn't going to go into too much detail because, like I say, there is a lot of information, but happy to take any questions or comments.
Thank you, Ben. That's extremely comprehensive report and well summarised. A lot of information in a few minutes, so well done. But first of all, before we go to any discussion, can I ask members whether they have any questions at all that will involve the confidential part of this paper? Because we have appendices which go into the details of some of the companies that we invest in. So if anybody's got any questions regarding those, we will defer that to the confidential section. So can I ask whether...
I may well do, but I'll save that for the confidential section. My question related more to the paper. Would you like me to ask the question relating to the paper now? I'll wait for a moment.
Any other questions likely to involve the confidential section? Well, I'll take that in the confidential section, but if you ask your general question now.
And it was more a request. In paragraph 14.2, we talk about risk management. And while I think those risks were probably appropriate for our previous meetings, the world situation seems to be changing dramatically. And the response to conflict and political instability is an area I think should be on the risk register in this section more prominently. So that was my only comment.
Yeah, that's a fair comment. We will look at the risk register and check that it's updated and reflecting the up-to-date risks. Thank you.
Any other questions? Yes, David?
This is a new councillor, new committee question. On the list of companies where there's obviously been some debate about investment, there's about 23 companies. And this might be somewhere else in the report, I missed it, but how many companies are we investing in total? So what proportion is this percentage-wise of our total?
That will be a huge number, looking across all of our managers. A lot of the managers almost invest in funds of funds. So there could be many underlying stocks with very small holdings. It's information we probably could pull out, but it's not something I could tell you at the moment, but it will be a big number.
So just a follow-up question. So how do these make it onto the list where the others don't?
Yeah, so do you mean in the voting or the engagements? So with the votes, they're votes that have been put forward by that company in which we hold a stock. And as an owner of that stock, we have a voting right. So it's a vote that's brought forward by that company. With engagements, there'll be, because something has happened that's possibly not in line with one of our policies or the manager's policies, or there's strong feeling around sort of actions. So an engagement will take place, and it may be through LAPF, it may be through the manager, or it may be direct as a request by the fund.
Sorry, could I just check if you mean the conflict zone investments? In it.
How do they get on the list?
Sorry, whereabouts in the report are you?
Confidential section, sir.
Yeah, I was going to say, I mean, I can generally say about the list, and so we've got a number of things going on in the confidential appendix that I can just say generally. The ones around conflict zone investments have come directly from the Palestine Solidarity Campaign. So on their website, they have analysed funds and looked at how much to have invested in certain investments. The other ones on that list, we have actually generated ourselves in terms of particular things we're looking at, which are described within that report. So it depends which part you're referring to, but if it's those conflict zone investments, then it's something different.
It's not confidential.
Okay.
It's generally, how do we choose companies to be? Yeah. Okay. Thank you.
I mean, in terms of the examples we bring forward, we try to give a flavour of what we think was most important to the committee, what you'd be most interested in terms of what's going on at the moment, anything topical, we kind of link it to that. So I'm not sure I'm still answering a direct question you've asked.
And it's partly to help me as a new chairman, but partly for our new committee members who may not know the answer to this. We've asked, questions in active management, ask questions or vote at AGMs or EGMs or whatever. And certainly we've seen that there are occasions when they do. On this particular occasion, they've all voted in accordance with our policies, but there will be occasions when they don't. What is our general attitude to that? Do we ask them to pursue the issue that they have concerned about, if they are so concerned that they've voted against it? Do they come back with recommendations to disinvest? Do they come back with recommendations as to how we might change their approach to ESG policies? This is a very general question. I'm not sure how investment managers deal with that, but what is our attitude to that?
Sure, thank you. Yeah, I mean, we trust our investment managers to know the investment world better than we do. So they have the right to vote as they feel correct. Generally, that is in line with our voting policy. Quite often, when we do see a different direction, they will give us all the information, and generally it's because they know something that's happened better. To give you an example, it might be voting for a certain member of the board to stay on the board, whereas the the voting guidelines suggest things like someone shouldn't stay in position for too long, but because they know that company and they know the situation and they know that person, they're happy to override it in that circumstance. So we're quite happy for managers to vote as they feel is right, because they're the experts in the field. But we would ask that they just give us the information, and generally it's a straightforward and obvious decision that they've made.
To clarify, and we may see this later in confidential report, Access, our pool, will have much the same approach.
That's correct, yeah.
No more questions. Once again, thank you very much, Ben. And we will move on. Oh, no, we won't move on. We will take a vote. The subcommittee is recommended to note the report and to note the climate engagement target list, which is actually in the exempt appendix, but we've noted it, and note the list of fund investment companies operating in conflict zones, also in exempt appendix A. We will return to that for your question in the confidential section. Can we take the vote at this point in the way that this is phrased, or do we wait for that question?
As the report is for noting, Chair, there's no vote required.
Yeah, well, so it's noting. Yeah. Thank you very much. We now turn to current topics in investment in the first quarter, and it's going to be introduced by Jonathan Crowther. Thank you very much for coming along, our investment advisor from Mercer's. So I invite you to present the report.
Thank you very much. So current topics. So this was produced back in early May, and as we've seen in the last few months, the world is incredibly volatile. So almost everything you bring out, every paper you bring to any committee or send is out of date almost as soon as it's written. And that's been evidenced this week particularly. So the impact of global political events and economic events that are happening at the moment, some impact on the fund, some don't. Some have much greater volatility of markets, some don't. The bit that we're going to focus on here in current topics, which I think is still relevant, even though there's been, as you'll see from slide 38, there's been a lot of announcements from the US president on what's happening with tariffs. It all started back in early February. We're going to put tariffs on China, then we're going to put more tariffs on China, then we're going to put more tariffs on China. Then we had this bizarrely named Liberation Day, where he basically wanted to then put tariffs on the rest of the world, and that was announced back in April the 2nd. What was the impact of all of these tariffs? Well, if you actually move on to the next slide, you can see what happened is that markets really didn't like it. If you look at those charts, sorry, it's on slide 8, you look at those slides, then what happened following the announcements in early April was that markets really did not like this at all. So equity markets fell. Why did they fall? Well, just real concern about, one, uncertainty of what's happening going forward, but two, a real impact on profits. In the end, tariffs means higher costs for goods, and somebody has to bear that extra cost. And that means what markets anticipate is that means we're going to have lower profits, there's going to be less investment, it's going to be a difficult ride. So market sentiment was very negative towards it. Probably the important chart on that particular page is the one in the middle, the US 10-year yield. The US is an enormous borrower of money from across the world. And so when it has to listen to its borrowers, it does actually stand up and take notice. And what the investors in those bonds were saying is, we really don't like what you're doing. And so what they're saying is, if you do all of these things, you'll have to borrow more money. It will be inflationary for your market. We think we'll want a higher rate of return from you for lending you that money. And that's pretty much what happened with bond markets. So we saw a very rapid rise up in bond yields of about 50, 60, 0.5%, or 50 basis points in the market vernacular. And that was a tremendously high move in markets. And that meant big drops in bond values. And that's really when the president then took notice of all this and suddenly announced that they were going to put tariffs on hold. They're going to have a pause, well, because everybody was ringing him up and wanted to negotiate. They couldn't deal with it all. So that settled the nerves of the market. So you'll hear the term bond vigilantes. There's no vigilantes. It's just that investors want to be paid more if there's uncertainty, or they think that inflation is going to be higher. So the big date that we look forward to going forward is probably the 9th of July, because we've had additional tariffs around the edges, but the main ones have been these reciprocal tariffs. And so whilst we're on pause at the moment, there is going to be increased nervousness, I suspect, as we approach July the 9th, and it's not clear whether we'll be in a long-term stable position of 10% extra for everybody on US goods imported into the US, or whether there'll be another spike back to where we were at the end of March and early April. So I think that is the real big driver that affects the fund more, in terms of that's where investment markets are moving, depending on what happens there. In terms of you are a long-term investor, you've got liabilities that you'll be paying 80, 90, maybe even 100 years from now. So short-term market noise is something that you need to be mindful of and consider, but in the longer term is not necessarily going to drive your investment decisions. So I think everything that's happening around tariffs at this point in time is definitely short-term. If I move you along to page 43, that's really just reinforcing this point around your objectives. So your time, the things that really matter is your perspective on risk and your time horizons. The longer your time horizon, the more relaxed you can be about short-term risk. Now, that doesn't mean that as a fund, you can just take lots of risk. You take measured risk. You take risk where you expect to be rewarded. And so one of the things that has generated very strong returns for the fund, and certainly in the recent past, have been equities. So continue to have a high allocation to equities. That will be reviewed as we go through the valuation process, which is coming up over the next few months and into Q1 of 2026. But what you do as a fund is you also diversify, which is the very simple eggs and baskets mentality, is that actually we try and invest in a broad range of assets so that if one particular asset class does very badly, others will compensate by doing well, so that we still get a rate of return that we want to achieve over that which we need to meet the payments on our liabilities, but we try and reduce some of that volatility. So the big decisions that the committee makes, which is tied to current topics, is all about strategic asset allocation. Most of the returns that are generated from the fund will be determined on the asset allocation decision. So how much am I in growth assets? How much am I in assets that behave more like my liabilities? That is what drives 90% of the returns for the funds. There are other areas that can add returns. So manager alpha, what does that mean? It means managers outperforming a benchmark that they're set. So that's another source of return. Tends to involve quite a lot of time and effort for committees, but actually in terms of the overall impact is quite small. And part of the Fit for Future consultation has been addressing that, in that I'm sure you will come back to this in the weeks and months ahead, that part of the government's criteria for Fit for the Future of pension schemes is that committees such as this should be focused much more on strategic asset allocation and manager selection, tactical or dynamic asset allocation. That should be the responsibility of the pools. And so that is the direction of travel going forward. So just moving on to ahead to talk about impact on private markets, which the fund again has an increasing allocation to private markets, and that's because we have a long-term horizon, so we can afford not to require liquid assets all the time, and we can be paid an illiquidity premium for placing our money on with investors for asset classes for a longer period of time. One of the impacts on tariffs that we'll see is potentially threefold. First one is that the impact of tariffs, as we said, is generally uncertainty for business, but also is negative in terms of profitability. So we expect a slowdown in activity in private markets, just that you invest in these private market assets and then they tend to go to markets or there's capital return. We just expect that whole period of distributions, calling for capital and fundraising to just slow off in the next few months, so that we'll expect that as we go into 2026, we should start to see a pickup in that, but it should slow over the next few months. There's also a numerator and denominator effect. This is really about, if you think about your allocation across different asset classes, if public markets are falling because sentiment is volatile and markets move down, then those assets are driven by sentiment and by value, and they're measured on a daily basis. So they can drop if sentiment, as we saw in April, was negative. Private market assets aren't valued on a daily basis. They're valued at set periods of time, either quarterly, semi-annual, annual, and they just reflect value. So sentiment doesn't really drive them in the very short term. So if we see something like we happened in April, a big fall in public markets, the value of private markets probably won't be affected by that. So it might seem that you're having a higher allocation to private market assets, when in actual fact, it's just a numerator and denominator effect. So that's one of the things to be mindful of. And so we might see very volatile moves, V-shaped moves in equity markets and growth markets, but actually in 6 months or a year's time, we might look at private markets and it just trundles through because it's not really impacted by this sentiment view. And the final point to mention is there that if we have a more sustained downturn, and the real concern here will be a recession, where obviously value of companies is going to fall in a recession, then we'll tend to see that private markets lag public markets. If a recession is coming, it's priced into markets. Markets tend to look 6 months ahead. So if they think there's a recession arriving, prices will be marked down. You'll see that immediately. In private markets, it'll be slightly different because, again, it's measured on the value of businesses and companies, and that just takes longer to emerge through. So it might be that rather than being, if recession starts today, your private market assets might not reflect that in their values for 3, 6, or maybe 9 months' time. So those are just things to be aware with private markets. Just finally touching on this, and then I'll up to questions because there's lots of current topics. As I said, I think this is important because it affects your strategic asset allocation and how you think about investing in the fund. Just re-emphasizing some of the impacts or takeaways for recessions on page 47 is, again, we know recession means that profitability of companies will be reduced. So that's going to affect the cash flows out of companies. So if you've got a mature portfolio, there'll be lower and less and slower distributions in the past. With these private market assets, you tend to recycle them in all the time. So you might see a net effect of having to sell some of your liquid assets because you want to maintain a certain level because you expect part of it will fall at the same time as you'll commit to other assets. And while there's imbalance, your allocation stays stable. If your distributions slow off, you'll still need to commit. Otherwise, in a few years' time, you'll find you're underweight that allocation. And so because of that, you might then have to draw some of your liquid assets to actually fund those future commitments for private markets. Valuations, as I said, I made a point about that. In terms of valuations, will reflect a lagging of what happens in public markets. Sometimes that's a good thing. So if it goes up and down, doesn't really matter. But if it's a sustained downward movement, then it will be slower coming through. And then finally, the other one in terms of new commitments. One of the things that if we do enter into a recession, a significant market downturn, part of the view is, oh, maybe we should just pause our private market investments. Actually, it tends to be the opposite with private markets. It's not a time to pause. Sometimes the best opportunities to invest in these private markets is after we've had a significant downturn because there is less appetite, less desire to invest in these markets. So it's a time to actually hold your nerve and continue to invest, provided the opportunities that the managers identify are robust in the long term. Then you tend to avoid pausing investment through recessions and market downturns. So I'm happy to take, I know there's lots more going. Happy to take questions.
Well, thank you very, very much for that very complex matter. I've always thought of the world economy as not stable. It obviously is growing, a bit like the universe, they say, but money has to go somewhere. And if one market is going up or public, private investment is going down, public, we hope investment will match it and give solidity. The game obviously is to be ahead of what is happening and make sure that we do meet the risks and meet the returns. I will ask a question myself in a moment, but I'm going to ask colleagues if they have any questions first.
I note on page 7 on the Q2 to the 2nd of May 25 market movements, a steep decline in commodities, which reflects, I looked at the other report on the table and that showed an increase before. I wonder whether you may comment on that steep decline. Sorry. It still is the reserve currency of the world, but will it continue to be so? I think that is a moot point at this stage. Okay.
Thank you. It's always interesting seeing these kind of things. But obviously, where you have active engagement within the markets, despite the fact the markets are actually declining, there is actually quite significant opportunity to gain from decline, as it were. And I assume that that is actually happening with active management that we don't see directly.
Yes, one of the things we'll talk about later on is the different styles of equity management. So growth managers, quality managers, value managers. The one that Councillor Whelan's referring to that would do well in this, and one of your managers had a good run, are value managers. So value managers are investment managers that look to buy companies that they think represent good, solid growth, profitability, but are unloved by the market for whatever reason. So their value is quite cheap. And so all of their focus is on the metrics that determine, relative to what the business is doing, are the metrics surrounding that company looking cheap. And if they are, well, they'll buy that company. So that's where you look for opportunities in the market like this. And so value performed quite strongly in Q1, whereas we look at growth managers, which traditionally have had a lot of tech. So Magnificent Seven companies did, and we'll see later when my colleague Philippe talks through performance, growth had a terrible Q1 because tech did extremely badly. So you saw an enormous drop off there.
And again, that's one thing we hear today with companies like NVIDIA suddenly growing quite strongly again after having had a poor performance. So thank you for that. Another question which comes out of something that you've actually said, but probably is for officers to answer. You mentioned obviously that with reductions in distributions from company, it's obviously going to have a negative impact on cash flow. And what we need to make sure is there is assurance that the cash flow management, and I do actually know the answer to this, but we need obviously assurance for everyone, particularly people who are new on here, that there is strong cash flow management in place so that those things don't actually become a problem, and that there isn't a fire sale, as it were, to fulfill that cash flow requirement.
Simple answer is yes. I think we've brought it to you before. There's a number of controls that we've got in there, and obviously we will bring in the draft accounts soon as well. So we can maybe pull that out a bit more when we're looking at the cash flow figures there.
So one of the things as well that we'll discuss when we get into the valuation and the investment strategy review is cash flow management for any pension fund is extremely important. In the past, funds such as this fund have had very strong positive cash flow in that employer contributions coming in have been adequate to meet the benefit payments going out. As we change and the scheme matures, that starts to get more into a balance. You then have to think about the natural cash flow that is thrown off your assets. And so for some of your bond assets, your gilt assets, they throw off natural cash flow on a regular basis. What you want to do is try and use that then to meet benefit payments. And it's something we'll talk about in the investment strategy review. But yeah, absolutely correct. There's a very difference between disinvesting on the 3rd of April and disinvesting on the 3rd of June. And that's one of the things that you want to try and manage your cash flow so that you're always generating natural cash flow to meet benefit payments.
I'm going to ask a not totally unrelated question. You mentioned the uncertainties in the USA market, and there are various ones, not only tariffs and the impact it will have on American stocks, but all of us around the world. But presumably America is such a large, first of all, investment market, that we can't really move, or can we move things away from there if we felt that there were risks or that the uncertainty was at a level that we were unable to accept? Hopefully we haven't got there yet, but we can see where the uncertainties might lie. And I just wonder how serious you think they are at this point.
I think it's very, very concerning time. For American markets have been sort of very robust for many, many years. Not so much robust in that they're not volatile, they don't go up and down. It's just the framework surrounding them and the support from the government has always been in one direction. I think that's what's been brought into question over the last few months. Is America the really solid, safe, legal base for investing that we've all understood and appreciated? I think that's what's really driving the uncertainty. Because America, as I said, is such a large market, so in equity markets, it's something like 60 or 70% of world markets. And also the dollar is hugely important, not just in equity markets, but in the global financial system. So the fund definitely looks at how it controls that risk. And we did some work last year on currency exposure, so exposure of the fund to the US dollar. And from that analysis, we determined that the fund was running something in the region of 40 to 50% of exposure to US dollar. That was something that the committee was discussed and was comfortable with, because there is the ability, and we took some measures. We were slightly higher than that, and there was some nervous about what happens if the dollar weakens, and actually it has weakened. And so back in Q3 of last year, we did some work to move from asset classes in the infrastructure vehicles that were dollar denominated. We moved those into classes that were hedged, so that they were actually effectively getting sterling returns and hedging out that dollar risk. So it's something to always continue to be mindful of. I think short-term movements are always challenging to pick. And as I said right at the very beginning, your investment returns will be generated through long-term views and strategic asset allocation. But you always have to be mindful of short-term. And have we getting a regime change? That's the key thing. And I think at this point in time, we're in a reasonable position in terms of we've had a fall in markets and a bounce back. The asset values have dropped in Q1, but have probably recovered slightly in Q2. So I think depends where we go in two fronts. The first one, I think, depends on where we go with the tariff situation. If we go into a world where tariffs are going to be 10% or relatively fixed, markets just like certainty. If we know it's 10%, they will adjust and they will adapt and things will move forward in a more sensible manner. What they don't like is it's 10% today, 25% tomorrow, 45% next week, the week after 15%. That they just, everybody who's been involved in any sort of budgeting and planning knows you just cannot work in that type of environment. So I think stability is certainly from the government is one thing that we'd look for in markets. The other is on the geopolitical front, which we issued a paper on Monday morning that immediately became out of date almost on Monday evening, and that's been the way that the world has moved recently. So obviously the attacks by the US on Iran over the weekend had some concerning potential repercussions for the oil price, because the concern was you play out a range of dark scenarios and you end up with oil, instead of being at $65 a barrel, is at $110 a barrel, and that's a very different world. And it's not just things like oil, it's things like fertilizers that travel through that region. I think it's 40% of the world's fertilizers come through that region. So you can see the impact for inflation, higher costs, if that happens. At this point, the tension in the Iran-Israeli-US interconnection seems to have been taken down a notch, which I think everybody would welcome. And so at this point in time, that has stabilized to an extent, but it's one of those that I think we have to be mindful of, not for anything other than what if we see a supply side shock, i.e. something happens to the price of commodities. That oil affects everything, pretty much, transport and what we do. And I know we're trying to move away from that, and that's for a different discussion. But also the things in terms of the cost of food, which is fertilizers for just basically growing crops, and much of the problems that came out of the Ukraine conflict was all connected to the price of food.
Thank you. I mean, that's a very comprehensive answer indeed, particularly on the financial aspects of it as well. I suppose what I had in mind, it's a legitimate question, is the American market so big that we cannot ignore it? We will always be investing in it, or aspects of it. And of course, we are led to believe, but I don't know how true this is, that some of those companies, in order to please the current regime at any rate, will be moving away from some of their ESG responsibility. Forget the conflict zones and other aspects, but things like EDI and emissions and net zero and so forth. And again, that's about sustainability in my view. So is that a factor as well in as it were? I'm not asking you to discuss investment policy at this strategy at this stage, but is that a factor that we should be looking at?
I think I'll come back to climate first. In terms of employment policy and diversity, exclusion, equality. So I effectively work in an American business. So Mercer are owned by an American parent. I think the way that our company has been looking at it, and I would expect most multinationals will look at it this way, is that those policies pretty much are in place to make sure that you hire good people and attract the right pot of people, which will drive your business forward. So they're good business policies. So there's always going to be a narrative that drives you in a particular direction, which you have to sort of step back from and say, how do companies run their businesses? Well, they run to hire good people. Those good people need to be treated correctly, rewarded and incentivized to stay with the company so that the company can grow. And I think that will just continue certainly within multinational businesses and a lot of the larger businesses. So I think the rhetoric can be parked to one side, and what people say and what they do are slightly different in my experience. In terms of climate, that's been a little bit more of a concern in the way that the US market is driven. I think that's a wait and see how investment managers react to that and respond. Clearly, again, as a global investment business, we are nothing that we profess or believe or have certainly been advising either to managers or to investors over the last 6 to 12 months has changed, other than we continue to think that there is a challenge and that needs to be focused upon to prevent funds ending up with trapped value. You know, that if we drive into a certain particular asset class because we think now it's a great flavour, we may find in 5 years' time that we've got very large amounts of trapped value that are just going to decrease because we haven't looked at the wider picture and where things are going. So I think from our perspective and from your perspective, it's always better to have a balanced view. And we would anticipate that most of the managers we deal with and the companies that they invested will need to maintain that manage and balance view going forward. There will be pockets of people where it's, you know, it's a real, for them, it's days in the sunshine at the moment, and they will take advantage of that. But that doesn't mean that in the long term it will be beneficial for them.
Sorry. Any more questions? Let's move to the recommendation, which is to note the report. Thank you very much. Thank you. We now move to item 8, which is the quarterly monitoring report. I think, who's going to do it? Looking around the room, sorry about that. Felipe Alves from Mercer is going to join me. Sorry, I've got the note here. You are joining us remotely. Again, I'm going to ask a question. There are some confidential aspects of this. If anybody's going to have questions on the confidential section, can they advise me now? You will. Okay, so we will come back to that in the confidential section. So I'm going to ask Philippe to present the public section of the report.
Sure. Hi, good morning, everyone. Let me just start by saying it's a big pleasure to be here presenting to you. I appreciate we have new members in the committee today, so feel free to direct any questions to either myself or to Jonathan. We will be happy to address them either when I'll be over presenting the report, or feel free to interrupt me as I go through the performance report. So today I will be covering the first quarter of the year, and we now are towards the mid of the year, so it feels like ages ago talking about markets in the beginning of the year in such a volatile world. But jumping on to the executive dashboard page, which is page 1 of the performance report. So in summary, over the first quarter of the year, the fund's liabilities increased slightly, whereas the fund's assets decreased over the quarter, mostly driven by negative performance posted by equity mandates. These had the result of decreasing the estimated funding level of the funds from 181% to 170%. However, I would note that the 31st of March 2025 is the valuation date when the actuary will recast the fund's liability value with updated assumptions and methodology. So I would caution on read these numbers at the moment because, yeah, they will be recasted. In any case, I think it's good to see how the funding level has evolved since the 31st of March 2022, which is the last valuation date, and the fund had enjoyed a good run from financial markets, and the funding level actually improved quite significantly from 125 to 170 over the 3-year period. In terms of asset allocation, there were 2 main rebalancing trades over the quarter. These were completed in February. So about 25 million assets were invested in multi-asset credit with M&G. And there was also a rebalancing and risk management trades implemented over the quarter, where 75 million assets were switched from the passive equity mandate managed by UBS to passive gilts. This was mainly to reduce the overweight position in equities, mostly in passive equities, and to increase the allocation to gilts towards the target allocation of that asset class. By the end of the quarter, there was an overweight position of about 1.8% in equities and an underweight position in alternatives of about 1.5%. This was mostly driven by an underweight allocation in infrastructure assets. We will see that in more detail later on. And in terms of fixed income, the actual allocation was broadly in line with the target allocation. In terms of performance, so over the quarter, the fund underperformed the benchmark by about 1.2%. However, again, I would caution on reading too much around this short-term relative performance. I will remind you that some benchmarks are absolute return benchmark, mostly on the alternative mandates like private equity and mostly infrastructure equity mandates, meaning that in a volatile environment, we would expect some of these funds to underperform an absolute target. And also, these are not really investable benchmarks, as we normally say. In terms of key contributors to relative performance, JO Hambro is definitely the key highlight. They underperformed the benchmark quite significantly. We will go there. Private equity also contributed negatively to returns. On the other side, M&G has actually contributed positively to the returns of the fund against the benchmark. I will now move on to the market background slide, page 2. I will not spend too much time here, but I would like just to draw your attention that, as Jonathan was saying, first quarter was quite volatile. Global equity markets are quite influenced by US equities, definitely. And as you can see on that page, UK equities have actually outperformed global equities significantly, posting a positive performance of about 4.5%, where global equities have posted a negative performance of 4%, mostly driven by US equities. It was a quarter marked by some geopolitical events, but also there was an event related to artificial intelligence when this DeepSeek tool was released in China, and this had some impact on companies that rely on artificial intelligence, such as the so-called Magnificent Seven. I would say NVIDIA, Microsoft, Apple, and others. And so this had an impact, quite a significant impact on the market, and US equities performed quite poorly over the quarter. On the fixed income side, on the more defensive side of the assets, so yields in the UK have broadly increased over the quarter, mostly the long-term gilt yields, and this had a negative impact. And so fixed interest yields and also indexing yields posted mostly negative performance over the quarter. So moving on to the page number 4, where we show the funding level progression. I've already covered this, but it's good to see that from the start of 2022 up until now, the fund has quite enjoyed a good improvement, I would say, in the funding level, even though it decreased in the last quarter. But I wouldn't read into much on short-term movements. Moving on to page 5, so this shows a summary of the asset allocation of the fund, and as you can see on the charts at the bottom, the fund is currently overweight to global equities and also government bonds. It's underweight what we call growth fixed income, non-government bonds, property, and infrastructure. The fund will be addressing these positions, but this is a good summary. We have also estimated a more recent positioning of the fund, and we estimate that these overweight positions global equities have actually increased recently to about 2.5% on the back of good performance posted by equities in the second quarter of the year. Moving on, I will probably jump on to page 7, where we can see manager allocation. Just to highlight that within equities, the most overweight position is actually on passive equities. So both UBS and Osmosis Core Equity, they are overweight their target allocation, mostly Osmosis. In terms of fixed income, the total allocation to fixed income is broadly in line with the target allocation. And over the quarter, we actually invested about 25 million with M&G to bring the allocation of non-government bonds closer to target. On page 8, we show the asset allocation for the alternative mandates, mostly property and private equity. There is a slight underweight position in property, mostly driven by M&G property mandates, but also CBRE property mandates, which is at the moment transitioning to the UK direct property portfolio, and they are actually managing a transitional portfolio on behalf of the fund. Private equity is overweight its target allocation. And on page 9, we see the actual asset allocation for infrastructure mandates. And as you can see, the total allocation as a percentage of total fund assets, it's about 6.6%, which compares with the target allocation of 8%. I must say that by the end of the quarter, the fund committed an extra 50 million of assets with IFM infrastructure equity, but it's likely that the manager will call these assets later in the year or perhaps in the first quarter of 2026. And this is due to the nature of the asset class. The manager will call capital as they see opportunities in the market. So this means even though the fund committed an extra 50 million to this asset class, it will take some time to increase the actual allocation as the manager calls capital. So moving on to page 10 on performance, and here we can deep dive a little and on which managers have contributed the most to short-term relative performance and also long-term relative performance. And I'm sure it will you will notice the underperformance posted by JO Hambro. They posted a negative return of about 12%, which compares with a negative return of the benchmark of 4.3%. This is quite significant. This is quite huge. This was mostly driven by what we call stock selection. What does this mean? So sometimes managers do what we call their bets on sectors. They try to go underweight or overweight the sectors they see that are more attractive at the moment, but they also, within sectors, they select the companies and the stocks they see as more attractive. And from what we have seen from attribution analysis provided by JO Hambro, it was actually their decisions on which companies to invest on that was poor. And this has driven these underperformance over the last 3 months to 31st of March. And it was mostly driven by tech stocks and also some financials and materials. We have asked them for a performance update until the end of May. We understand they rebounded slightly in April. In May, they are performing in line with the benchmark. Jonathan will touch on later on the private section more on the equity portfolio review, and we will address any questions you may have around JO Hambro and the performance over the short and long term periods. On the other hand, Dodge & Cox outperformed the market, and this was mostly driven exactly by the fact that Dodge & Cox is a value equity manager, and they are not investing so heavily in tech stocks, and they enjoyed quite a good run in the first quarter by being underweight tech stocks. In any case, even in the long term, Dodge & Cox are posting quite strong performance relative to the benchmark. As for the passive equity mandates, UBS and Osmosis, they are performing in line with the benchmark as expected. Going down the table, we can also see the performance posted by growth fixed income managers, namely M&G and BlueBay. M&G has outperformed the benchmark over all periods shown here, which is good to see. On the other hand, BlueBay has actually been underperforming the benchmark, but we think that M&G and BlueBay are a good complement to each other as multi-asset credit mandates, and you would expect also this part of the portfolio to help you when equity markets perform poorly. Jumping on to page 11, where we show performance for the alternative mandates, I would just like to highlight one or two things here. So for the new members of the committee, let me just tell you that for private equity mandates, we show performance with a 1 quarter lag, because performance for Q1 was not available at the time of production of the report, and it's typically this every quarter. So we always show performance with a 1 quarter lag. In property, so managers have been mostly underperforming the benchmark over the short-term periods. It's been quite a tough environment, if I can say, for property mandates. But let me also say that in the case of the benchmark we use for property mandates, it includes an element of an absolute return. So the benchmark for these property mandates, it's about 2/3 market index, which is the UK monthly property index, but also 1/3 of 5% per annum absolute return. And in terms of alternatives, I would bring your attention more to the long-term performance of the mandates, because this is exactly what you are trying to achieve. You are trying to achieve an illiquidity premium with these mandates. And in the long term, private equity and infrastructure mandates have actually been posting good performance and strong performance. I guess the only exception might be UBS infrastructure. And I guess this brings me to the end of the presentation on the public version of the performance report. And I will stop here and perhaps just ask if there are any questions around the performance report.
Thank you, Philippe. That's very, very useful and very clear. I'm going to take questions. Members? I'm going to ask a question if nobody has a question. And the first thing is to say that I may be wrong in my assumption about this question. My understanding is that government has or will require us to increase our investment in infrastructure asset class, across the board in all the various aspects of it. Question really is, how long have we, if that is the case, how long have we got to do it? And we've got quite some way to go, haven't we? Because we've only, in fact, got 6.6, I think, at the moment, compared to the current benchmark of 8. It's going to go up to 10. And that will be quite a shift of investments in other classes. And of course, the investment strategy, or funding strategy, will work out where, investment strategy will work out where the balance will be. But it's going to be quite a movement of investments, isn't it? 3.4%. So presumably over a period of time. Sorry.
Yes, it will be a period of time. And if we take an example, slightly different to infrastructure, but timber, which the fund has done a lot of work on over the last 18 months in terms of investing into that. Deploying money into that market, any infrastructure market or something like Timberland, just takes time to do. And so remember I said earlier that you have a period with these private market portfolios where you ramp them up and build them. So you start at 8, you want to get to 10. You have to build to get to a sort of attempt to get to a higher level, because at some point you might get to 11 or 12, but then other bits of it will start maturing and falling away. And you want to try and build up and then stay in a stable state going forward. So you'll continually, as we go forward, be recommitting additional capital to infrastructure. At the same time, some of that infrastructure will be rolling off. So UBS, which Philippe mentioned, is a very old holding, and it's actually down to a very small rump of what's left. So it's quite volatile in terms of its value. That's not representing its real value of the long period that you had it. So that's one of the things to understand, is that even if you want to jump into a large allocation to infrastructure, it will take 2, 3, 4 years time to get your allocation increased, because they're projects in terms of, you think of what infrastructure is, and we will have a presentation later on from IFM who will be able to talk a lot more about that in terms of how they can build up commitments in the fund and what projects and opportunities come to them. It just takes time to actually deploy the money into the market.
Thank you. Has that directive been issued by government, or is it or just a general wish that funds should have 10% of their funds in infrastructure?
It was the first ambition they set was 5% original pooling. I mean, now we're now talking about sort of like UK productive assets in that kind of language, and I think the devil will be in the detail, I guess, when that comes out. And we've obviously got things like SME investment as well, which is clearly not infrastructure, but was cited by government as an example of something which they wanted to see. So there's a lot going on. I don't know.
I think that's right. There's no specific criteria at this point until we see the pensions bill and what's in the detail there. So we know there's mood music for more investment in infrastructure, more investment in the UK, but the devil will be in the detail of actually what funds are expected to do. In terms of this particular fund, this fund invests quite a lot of money into the UK in different guises at this point in time. So if there was unless it was some extremely large criteria for UK, the fund would sit quite well within UK investments. It's probably like they'll be looking at global equity markets, will be the first point of call in terms of how they view the world. And as I mentioned earlier, the UK now represents about 4 or 5% of global equity markets. 30 years ago, it's about 10%. So there's been that shrinkage in holdings naturally in the UK market because it's become smaller in terms of global markets, but also during that time, pension funds like local government pension funds have been investing more into global equities because of the diversified nature of a global equity investment holding, which, going back to fiduciary duty and doing the best for the members, that's what you're charged to do, is diversifying your allocations makes complete sense, unless you're getting, regulations from government directing you otherwise.
Thank you for that explanation. That's very useful. Any other questions? No, in that case, beg your pardon, sorry.
Just I understand that, investing, you've got a basket of different types of investments, different funds within those different types of investments. And I'm not trying to pick on anybody in this list, but at what point does performance become an issue?
I think we're going to move to the confidential section. We may well be discussing that particular point.
If I may just say, obviously, the pooling has caused us not to be able to do things that we would have otherwise done much earlier, and it has been a real challenge. We'll be talking, obviously, about a couple of specific funds where there have been performance issues in the confidential session and what to do about those. Even getting that report has been very difficult because our understanding of what might happen with regards to pooling going forward has been changing day by day. But you know, so it's reaching a point where you're comfortable with the decision that you're going to make. But I think the challenge has been more probably the external factors and us not being able to just do exactly what we want at the time with the timing we want to do it, that has caused some of these performance issues that are there.
Thank you. If there are no more further questions, I'm going to ask that we note the report. Thank you, Philippe and Jonathan, for your presentation. The remainder agenda items are exempt from publication, so the subcommittee will need to decide whether to exclude the public and press from the remainder of the meeting while these are discussed. This exclusion will be on the grounds that the reports contain exempt information under paragraph 3 of part 1 of Schedule 12A of the Local Government Act 1972 as amended, and it would not be in the public interest for this information to be disclosed. That is information relating to the financial or business affairs of any particular person, including the authority holding that information. So I ask if any subcommittee member objects to holding this next session in private. And if there are no objections, I will take it that we will now close the public part of the meeting and move to the exempt section. There's going to be a few minutes whilst all the recording materials are being switched off. You want to go at 12?